But I'll also take a test on it.
Oh, no?
Yeah, 80 on 3. Well, the 3 also, yeah. So I had 73 for the last one. You know?
Yeah.
First one is two. The first one is the one that makes the 2 or 3 wrong. The last one I got 1 wrong. I got one. I don't remember which one I got wrong. I got 9.
First one I got 6.
Yes.
I didn't want to keep the exam, so I got to.
Thank you.
You have to?
Sorry. 90. No, what we just said. Ah, you just wrote it. And that's what you said. I'm trying to get it hotter. Like, I'm only 75 on this one. I'm going to take the exam and try to boost that. Yeah. Might as well, doesn't hurt.
Yeah.
I had 87 next in the last test, and I took the test. I got 75.
So it can't hurt you. Thank you.
But it's much better when we make the test the same day of the class.
That's what?
It's much better when you take the test at the same day of the class.
Yeah.
Because the first test, the class was last week. So I was kind of...
Okay, make sure you got the spreadsheet pulled up that I sent you yesterday. Everybody got it pulled up?
Yeah.
And does everybody have the handout that I just passed
The
out?
whole thing? Yes. So no test for you?
Which is the spreadsheet.
Lucky man.
The only one I have wrong is 19, 7, 20.
Okay. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. A couple people. All right, well, let's go and get started. So what I have sent you is a combination of both an after-tax as well as a before-tax model. Originally, we were going to be scheduled today to just do the before-tax, but since we already kind of introduced it a couple of weeks ago, I figured what the heck, we'll go ahead and jump forward and do both before-tax and after-tax today. And then that'll free us up to do another spreadsheet for one of the other classes. So, this one, once again, fully populated. And so what we're going to do is kind of walk through it, explain everything that you sort of need to know about this one, and some of the unique features that deal with some of the after-tax issues. So those of you, there's a couple of you in here that have taken the investments course, so this can be kind of a refresher for you. Those of you that have not taken the investments course, this will be brand new stuff, so not a problem. All right, so the way this model is obviously set up, much like the others, you've got a whole series of inputs up here toward the top that obviously we use down below to kind of populate the pro forma. And then we've got a number of sort of return calculations and then also some cash flows and a handful of other things. So we'll just kind of walk ourselves through this. All right. So to sort of start us off, much like the financial feasibility analysis spreadsheet and others, we start off with some of the basic property information in terms of the rentable square feet in the property, the actual rent per square foot per year. So in this case, those should be fairly normal to you in terms of what they are. Same sort of thing with the vacancy rate, 7% here, other income per year of $15,000, and then the annual operating expenses based on effective gross income, in this case only 5%, and then a required debt service coverage ratio by the lender of 1.3. Okay, I don't think any of that is new to you. Is that correct? It shouldn't be, because we've been doing this stuff quite some time. So hopefully that is all just normal. Okay, so the actual first calculation that gets done, that you don't have to do, that obviously is being done by the spreadsheet, is to calculate the NOI. Now, without actually pulling up the formula, how would you be getting NOI? What variables are you using to get that? Well, are you?
Operating expenses.
Okay. So you're taking basically what? To get the calculated NOI, you're getting that indirectly by what?
Operating expenses minus big, or plus the.
Gross income minus ECL.
Plus other income,
And they
gives us
affect gross income. Yeah.
effective gross income, subtract out our operating expenses, gives us an operating income, and then subtract out annual debt service, gives us basically the forecast cash flow. Okay. All right. So in this case, if you look specifically at the formula that was used to get the net operating income, all it's doing is it's pulling from down below, cell B25 to be exact, okay? So it's simply pulling from down below, flip this thing so I can use it. So in terms of the actual calculations that are being popped in here, it's just simply pulling up that net operating income number from down below, all right? Now, the maximum annual debt service based on the debt service coverage ratio, that is simply going to be using your net operating income, which is right there, divided by the debt service coverage ratio right above it, which will give us the maximum annual debt service based on the debt service coverage ratio. We've done that before, okay? Once again, so far, nothing new, okay? Then, the maximum monthly debt service based on the annual debt service. So this is just simply taking the annual debt service and dividing it by 12, okay, to get our monthly mortgage payment, okay, or monthly debt service. Okay, then we have basically our loan information, very straightforward, the interest rate on the loan of 4.5%, 25-year term, okay. Then based on that, we're using the present value formula to calculate what's our loan amount, okay. So we're sort of backing into that using that monthly mortgage payment, that interest rate, and that term. That makes sense? Once again, we've done all that before. All right? Then we take that amount and we use our loan to value ratio to back into the value of the property. So in essence, we are taking the loan amount divided by the maximum loan to value ratio to back into the maximum value of the property. Okay, does that make sense? So it's a reverse calculation, but we've done it before, okay? Now, based on that number, the $31,465,000, if we take that number, subtract out the calculated loan amount, then we should get our required equity that we need to put into the property in terms of our equity investment or down payment, okay? Make sense? Okay, any questions on that?
Oh, yeah, no.
Okay? Now, let's go and take a look at a couple of these things up here at the top. Specifically, just the annual rent growth rate. I put it at 3%. So we're going to have our growth on our income at 3% a year, and then our operating expenses are going to grow at 4% a year. Okay, for right now, ignore all of this stuff about depreciation. Okay, we're going to come back to that when we start talking about the after-tax stuff, and that's also sort of the new stuff. Okay, so let's just take a look at basically years 1 through 5 and what's happening down here in terms of our before tax cash flows. Okay, do we all understand how we come up with each of those numbers? Okay, in other words, where each one of these, we've done this before, but I just want to make sure. So obviously with the potential gross income, we are just pulling from above in terms of our square footage times our rental rate. That becomes our potential gross income. Okay, and then simply as we go across, what is happening is we are multiplying that income number by the growth rate in the income. Okay, so everybody see that? Okay, once again, nothing new there. Okay, and that continues all the way across. And I'm going to talk about year 6 here in just a second, but right now just focus on years 1 through 5.
Are you multiplying by annual rent growth or annual OPEX growth rate?
The income growth rate. Okay. Vacancies and collection losses, we're keeping it as a fixed percentage all the way across. In this case, I believe, yeah, 7%. Now, one thing to point out here, everybody who builds a model like this, they have their own sort of preferences as to how they deal with some of the different assumptions and how they change and how they don't change and that sort of thing. This particular model, I simply made the decision or the assumption to fix my vacancy and collection losses as a fixed percentage of 7% all the way across the property. That's not an absolute. Matter of fact, it probably is not even going to be accurate, you know, from the standpoint that obviously if it's the first year you own the property and you're going through lease up, that first year you're probably going to have a much higher vacancy and collection loss than you will in the subsequent years. But that's a decision that you've got to sort of make up front as to, or you can actually go back and make it change from one year to the next, okay? And that may actually be one of the things we've got to do here in a little bit, okay? Other income, same thing. I just fixed it at a dollar amount all the way across, okay? So nothing was changing there. Once again, this is an assumption that I made. Doesn't necessarily mean that it has to be that way, okay? And then the operating expenses, I fixed that as a percentage of the effective gross income. Once again, you could vary that from year to year, okay? Which I think we actually did, which was to say, whoops. Yeah, we have an annual operating expense growth rate of 4%, so that number, while the first year is based off of the effective gross income, the subsequent years are simply being grown at a 4% growth rate. Okay, does that make sense? All right, moving on down. Okay, and so that, obviously doing all those calculations, that gets us to our net operating income. Now, the one thing I want to sort of point out is you notice there's a year 6. Does anybody remember, we talked about this, why do we calculate year 6 all the way down to net operating income, but we stop there?
For the reversion.
For the reversion, okay? Because to calculate a reversion, we always base the reversion value off of the subsequent year's income stream, okay? To apply the cap rate. So we only calculate it down to the net operating income because that's all that really matters to us, okay? All right, moving on. Okay, our annual debt service, that number's fixed all the way across, and then we get our before tax cash flow. Okay, all of that should have been just completely a review. Nothing new there. Was there? In your mind? I don't think there was. Okay, now, here's where it begins to be fun. Okay? When we start dealing with tax-related things. And obviously, a lot of this is probably about to change in terms of some of the different tax rates, as well as some of the different deductions and a handful of other things. We don't quite know. The last time that we had a major overhaul was probably in 1986. You know, so a good 30 years ago was, I mean, we had a minor one back in the early 90s or mid 90s, but nothing like the one in 86 that really changed everything for real estate. And that's one of the reasons we had the real estate crash that we did in the late 80s, was because of tax law changes. So let's talk about what is actually happening here. Now, the way I always typically sort of start off any discussion as it relates to income taxes is there's a very different distinction between the tax world and the real world, okay? The tax world is one that is governed by rules and regulations that are very precise and dictatorial as to, you know, how things are impacted and affected and how values may be impacted and affected. The real world, there are usually a whole bunch of other extraneous variables that may impact things that don't necessarily align at all with the tax world, okay? So in other words, what I'm sort of saying is the tax world, to a certain extent, is its own sort of animal in terms of how it behaves. And just because the tax world sort of says the value of your property is this, doesn't mean it is, okay? Or that, you know, the depreciation is this and versus the real world. So try to make a complete disconnect between sort of the tax world and the real world. Okay, that having been said, part of what we have to do is to take a look at some of the different variables that get impacted within the tax world. One of the things that we deal with in the tax world is depreciation, okay? And in the tax world, it has been determined that commercial real estate properties have a 39-year useful life. Why 39? Why not 45? Why not 25? Because Congress said the useful life of a commercial property is 39 years, okay? Now, in their minds, that is simply saying that over 39 years, your property goes down in value equally from one year to the next by 1/39, okay? Does that make sense? Okay? Not saying that matches up at all with reality, but that is how they set it up. Now, residential properties have a tax life or depreciation life of how many years? 27.5 years, okay? Not 27, but 27.5. So, why do you think you would give a different depreciable life to residential properties versus commercial properties? In your mind, if you had to give a rational explanation, why would you give a longer useful life to commercial properties relative to residential?
Could it be that I mean, at night you're at home, at night maybe you're in your commercial property, so you're not using it as much. And also, the utilities that you have in the residential is much more than you would have in the commercial block, right?
Yeah, I mean, that's possibly an explanation. I'm not sure that that's
The reason?
the reason. Anybody else?
Yeah, maybe American lifestyle, raising families, people that in the house. That's kind of a calculated average. Raising kids, sending them to college, how long people will stay in their house before they retire, maybe move on. I don't know,
Okay,
just
possibly.
a guess.
All right, anybody else? Yep.
Material use, no?
Yeah, that's the one I tend to gravitate toward. That commercial properties as a whole, if you think about them, much higher quality of construction. You know, that most, I mean, now Florida's a little bit different in the sense that we've got to hurricane-proof everything. So residential properties are probably pretty close to almost the same standard as industrial, in the fact that they're built out of, you know, concrete masonry units and that sort of thing. But most of the country, that's not the case. And residential, you know, homes, you know, it's just stick frame construction that, you know, may not really be expected to last, you know, that long of a period of time. But as a general rule, I think the logic was, yeah, materials are probably going to be a little bit more expensive, and you're going to have a higher quality of construction overall, and you're going to have a higher durability that you need to have in place for commercial buildings than you do with residential. And so they just kind of arbitrarily, you know, sort of determined, okay, 27.5 years for residential, 39 years for commercial. Interesting note about that is that prior to basically the 86 tax laws, we had, it was like a 31.5 year depreciation term for commercial, but they upped it. And part of the reason why they upped it was because they felt that that was too short of a depreciation term and people were getting too much of a tax benefit from the depreciation, and they wanted to potentially have that as a less impactful sort of issue on owning commercial real estate. And what I mean by that is, think about it like this. Well, tax policy is probably one of the most boring things that most of us would tend to want to think about and want to imagine. But every one of those decisions that are made about tax policy not only impacts you potentially as an individual, but as an investor in terms of the ownership that you have of these properties, and can, in some cases, make or break your investment decision, okay? As boring as they may be, all of a sudden a change in tax policy makes your property unprofitable or makes it more profitable. You know, so instead of necessarily just sort of sitting back and not really, you know, thinking about this, it's one of those things that, you know, can have huge implications on the income that you generate, okay? Yep.
Do the banks also calculate that when they want to lend you money?
In what way?
The 39 years and the 27? Because
No.
you have a lot of properties that are like 30 years old, so do they deduct the price?
Yeah, I mean, whenever they have an appraisal done, the appraisal is going to estimate the effective age of the property, which is not necessarily going to be anywhere close to what the tax depreciation value is.
Okay, thank you.
And on a personal level, when you buy it, doesn't the depreciable life start over again?
Yes.
Yeah. New purchase.
Okay.
So there's a whole other side to this that's fascinating, that let's say I buy a property today, it's a brand new property, okay? You know, just been built. So I start the clock on my depreciation. If it's residential, I start the clock over 27.5 years. If it's commercial, over 39 years. But let's say 5 years later, I sell whatever property I own to you. The depreciation clock starts over.
So I got 39 years then.
Yes. Okay? Once again, this is what I'm saying. Tax world versus real world. Okay? You know, and so as a result, that, you know,
Depreciation is equal for me and you.
well, yes and no. I mean, it's in terms of where we start. But the problem is, you have a 5-year-old building that has 5 years probably worth of wear and tear associated with it.
Correct.
Okay? And now you're sort of starting the clock all over. Doesn't necessarily match up, is what I'm saying. Okay? But that's what I'm trying to get at whenever I'm saying the two worlds aren't necessarily,
They don't think the same.
yeah, they're not in alignment. Okay. So let's just sort of take a look at this whole business of depreciation here for a second. All right? So one of the input cells that you have to make a determination on is whether the property is commercial or whether it's residential. If it's commercial, it's going to be 39 years. If it's residential, 27.5. And you have to, I believe, just hard code the number in there. I didn't make it like a nifty little if-then thing. We maybe try to do that a little bit later. But what is important is what follows next, and that is what percentage of the overall property's value is actually depreciable. And what we mean by this is only improvements are depreciable, meaning land is not depreciable for tax purposes. So the idea behind that is land is forever, you know, and so it doesn't make sense to depreciate or write off the value of the land from one year to the next, because it should be basically constant or fixed and, you know, should not be depreciated. Now you could make some arguments that, well, what if it, it's like got toxic waste on it, or, something like that, you maybe could make an argument, yeah, it's been depreciated, but for the most part, it doesn't depreciate. So what you've got to do is basically say, what is the overall value of this property? And you're going to apply basically 80% to that, and then simply say, that is going to be my depreciable value for the property. All right, so in this case, to see what value we're using, my suspicion is we're using, over here, the overall value of the property. So let's take a look at this. 31,465,853.98. All right, so this is the overall value of the property, and we are saying that of this value, we're going to assume that 80% is attributable to the improvements, okay? In other words, the buildings or structures on the property. So 31,465, 853.98 times 0.8. Okay, so it's going to mean 25,172,683.18 is the actual value of the improvements. And the difference between those two would be the value of the what? The land. Okay, does that make sense to everybody? Yeah. All right. Now, if that is 80% of the value, this is the value of the improvements, this is the depreciable value, and our property happens to be commercial, we're going to take this number and divide it by 39 years. Okay? So divided by 39, you get 645, 453, 41. So that should match up with what we've got up here under annual depreciation. Okay, does that make sense? Okay, so this is the annual amount of depreciation for a commercial property where 80% of the value is attributed to the improvements. There is our depreciable value each year that we can write off. Now, what does that actually mean? That means, technically, for income tax purposes, we take that overall value of the 31 million, and each year, we're basically, for 39 years, we're really subtracting out $645,000 off of that value until it basically gets to zero. Does that make sense? So the improvements get to zero, not the land. Okay, so at the end of 39 years, the value of the property will be just the land value. Does that make sense? Okay, now, of course, the IRS doesn't always make things simple. Okay, they have to complicate things up a little bit. And so one of the things that they put into the regulations is they want to avoid people gaming the system, okay? And so they require you to identify when the property was placed into service, meaning what month was it placed into service. Because here's the thing. If you place it into service, let's say January 1st, that's 12 months of depreciation, which is what you think you should be getting, yes? But what if you waited until December 31st to actually buy the property and place it into service, if the IRS didn't basically have this, what we call mid-month convention, then you would get a full 12 months worth of depreciation. You'd be gaming the system, if you will. Well, they want to keep you from doing that, so they have what is referred to as a mid-month convention, meaning that whatever month you place it into service, you only get to take the depreciation from the 15th of that month. So if you place it into service at the 1st of the month, or you place it into service the 30th, the 31st of the month, or you place it into service the 5th, the 20th, whatever, the IRS automatically makes the assumption that it's placed into service on the 15th or middle of the month. That's called the mid-month convention, okay? So you've got two things going on here that are important. One is the month that it's placed into service, which month in the year, and the other is the mid-month convention, so that you only get half a month. Now, what that actually translates into, as a practical matter, is if you place it into service in, let's kind of run down through these, January, February, March, April, May, June, July, August, September, October, November, December, okay? For January, because of the mid-month convention, you get 11 and a half months of depreciation. For February, 10 and a half, 9 and a half, 8 and a half, 7 and a half, 6 and a half, 5 and a half, 4 and a half, 3 and a half, 2 and a half, 1 and a half, and half a month. Okay? Now you're saying it's an awful lot of detail. Well, it is, but it's also extremely important because this will cost you or benefit you thousands of dollars. Okay? In the fact that you've got to know when the property was placed into service. Now, placed into service is not the same inherently as whenever you purchased the property, okay? Because you purchase raw land, you build a building on that raw land, but that building is not available for occupancy until maybe, a year or two later, so it's technically not going to be placed into service until it's open for occupancy. Okay? That's when you get to begin collecting depreciation. Now, if we use the example of what Ken had suggested earlier, that I own the property for, let's say, 5 years, and I sell it to Payment after 5 years, Payment buys an operating property from me, okay? Under those circumstances, if we keep the doors open, we never close them, then you're able, the day of the closing, to say the property is placed into service that day. All right? So, why am I going into all this detail? Well, because it matters for the calculation for the depreciation, okay? So, in this particular spreadsheet, it asks for what is the month it's placed into service. And here, I said it was month 10, which would have been October, okay? And so, based upon that, our depreciation gets adjusted, okay? So let's see if we can do the calculation. So what that means is, if it's placed into service, basically here in October, that means I'm getting 2.5 months out of 12 of depreciation. Does that make sense? Okay? 2.5 months out of 12. Okay, there are 12 months in a year, and if I place it into service in October, I'm getting 2.5 months of depreciation for income tax purposes. So what we would do is we take this number, this is our annual number, divide it by 12 to get a monthly number. And we get 53,787.78 is our monthly depreciation. Okay? Well, if we place it into service in October, as we said, we're getting 2.5 months worth of depreciation. So that means that we're getting $134,469.46 worth of depreciation for that first year. Does that make sense?
For the first year? Oh, yeah.
For the first year only. So now, if we take a look at your spreadsheet on the handout or on your computer, and just scroll down specifically to the annual depreciation number or line, what do you see? First year is $134,000, and then it jumps up for every year thereafter to the 645,453. So you get the full year's worth of depreciation on every subsequent year, but for that first year, only based upon what month it's placed in the service. Now, one little thing that I did, take a look at the calculation here for the mid-month. This is a nifty little thing to kind of help to do what we just did. Basically what you're doing is you're taking the annual depreciation number, cell E11, and you're multiplying it by 12.5 months, since, once again, everything is kind of based on halves, minus what month it was placed into service, divided by 12. So think about this for a second. 12.5 minus October, which is 10, would be 2.5.
Right.
And so then all that divided by 12, and that gives us our depreciation for the mid-month. So it's just some simple math, okay? All right, now, moving on. Okay, everybody comfortable with doing that calculation? All right, moving forward. So once again, if I were just to ask you, what does depreciation represent for tax purposes? Give me an explanation.
Lessening of the taxable value.
Yes, I'll give you a good, simple explanation. It's just the lowering of the taxable basis or the taxable value of the property over time, okay, to theoretically reflect depreciation, wear and tear of the property, okay, deterioration, okay. Now, okay, this next one, I'm going to kind of explain what we're doing here with these little calculations, because you're probably like, why are we doing all these weird little calculations here? But I'm going to come to that in a second. One of the things that we need to do is to calculate interest expense. Now, how is interest expense different from your mortgage payment or your debt service? It's deductible, but more specifically, what's the actual difference between them?
It's minus the principal.
Minus the principal. In other words, the interest portion, separate, if you get the mortgage payment overall, you subtract out the interest, you have left over the principal payment. Okay? Well, here's the thing. For income tax purposes, only the interest portion is tax deductible, not the full payment. Okay? So what you're beginning to see here with this little subroutine calculation is that for income tax purposes, what we're doing is we're subtracting out what we can deduct, okay, from our overall value or our overall income on the property. And so we're starting off with net operating income, and we're subtracting out the annual depreciation, we're subtracting out the interest expense, and once we've subtracted out those two, and there are others that we can include in there to make this more complicated, like for example, amortization of points. We could also be subtracting out other financing costs and things like that, but in this particular case, we're trying to keep it simple. But after we subtract those out, that then gives us what is now going to be referred to as our taxable income. Okay, so it's not our net operating income that's being taxed in the full. It's only after we've adjusted that for depreciation and interest expense that that's going to change our taxable income. Now think about this just for a second. Don't make this more complicated than what it really is. What if they disallowed interest deductions? What if they disallowed depreciation deductions? All other things being equal, we would pay more tax. Does everybody see that? Okay, so that's why tax law matters, is because if all of a sudden they say, okay, the depreciation term has changed from 39 years to maybe 45 years or to 10 years or whatever, that's going to dramatically influence this number. Okay? I mean, just look, right now, look, since we've got this sort of fixed, let's just go up and let's just say we change it to make it a residential property. just to see how much of a difference it would make. Okay, so going from 39 years to 27.5. No other changes. All right? You automatically see the annual depreciation amount went from $645,000 to $915,000, and then for that first year, it went up from 134 to 190. Well, let's come down here and just look at our income. You know, that's having a very significant, substantial impact on what our taxable income is as well for each of those years. Okay, which is obviously going to translate into how much tax payable would we have. Okay, if we look at the handout, just to make the comparison with what's up here on the board, we would have been paying $240,000 in taxes payable if it was a commercial property, but because it's residential, we're only going to have to pay $225,000. So a difference of 15 grand for that first year. For the subsequent year, though, it's a little bit more dramatic. We've got a difference here of $121,000 in taxes payable if it's commercial, but only $45,000 if it's residential. And the reason for that much of a difference is because we're only talking about 2.5 months here, whereas this is a full 12 months. So you're talking, about what, almost 80 grand roughly of difference in just the taxes on the property, nothing else. Does that make sense? Okay. So yes, it matters. Okay, let's put that back to where it was. Put that back to 39 years. Okay, as we continue to kind of work down through this. Okay, now then, we talked about what the interest expense is. How do we calculate it? How do we get it there? Take a look at the formula that's used here. This is one I don't believe we have used. Okay? It's the cumulative interest payment. Did we use that or not? No. I'm kind of beginning to think maybe we did for something, but
Mine just says 28% of the formula.
no. The interest expense.
Oh.
Okay? So this is another function. I don't think we use it in here, but I mean, does anybody remember whether we used it in this? I mean, I know we used it in the investments class, but I can't remember whether we used it in this one or not.
I think on the first spreadsheet, we used it,
Okay.
yeah.
Okay, well anyway, whether we have or we haven't, I'll go through and explain it again. Okay, the function is CUMIPMT, cumulative interest payment, okay? And then all we're accessing here, as you can sort of see, the interest rate, the number of periods, present value, and then the start period, and then the end period and time. Okay, so this is kind of like the amortization function on the calculator. The whole thing where we do shift, amortize, equal. That's basically what this thing is doing just for the interest piece, okay? And so if you take a look, and you kind of break it out, item by item, the B12 divided by 12 is simply the interest rate divided by 12. The B13 times 12 is simply the number of periods in months. But the part that, and then with the present value, which is simply B14, but the part that is interesting to us is the start period and the end period, okay? So what this is saying, for this particular point in time, this is the first 12 months, okay? So that is period number 1 through period number 12. Thus, the 1, 12, okay? The 0 is the type, which, once again, that is the whole beginning versus end of the month thing here, once again, end of the month, okay? But now, take a look at the cell to the right of this one, okay? The only difference that you're going to see is, now it's for year 2, periods number 13 to 24, okay? And the subsequent year would be 25, 36, then 37, 48, 49, 60, okay? Make sense? Okay. All right. So once again, a nifty little function here. Okay. Taxable income is kind of coming back to this. So all you're doing here is you're taking your net operating income, subtracting out your depreciation, subtracting out your interest expense to get taxable income. Now, what we're actually doing with these 1, 2, 3, 4, 5, 6 lines, this is what I always sort of refer to as sort of a tax calculation subroutine, okay? Because we're sort of taking information from one part of the spreadsheet and kind of just doing a set of calculations that we have to do to be able to come up with the bottom line, which is the taxes payable amount, okay? And so once we've got the taxable income from these first four, then we simply multiply that by whatever the appropriate marginal tax rate is. Well, is that not another thing that's under discussion right now with regard to the changing of the tax laws, okay? And so supposedly simplifying it down from whatever it is, 7 or 8 different tax brackets now down to maybe 4 or whatever it is. And obviously, as those change, that's going to impact obviously your tax liability, okay? Now, so the taxes payable, you're simply multiplying the taxable income times that tax rate to get the taxes payable. And we're going to make the assumption, which is a fairly valid assumption, that the tax rate is going to be roughly consistent across the page. Okay, moving forward.
Professor, we're paying interest in base of 12 months if we got the property on October?
Okay, good question. All right, so in this particular case, we are making the assumption that while the property was placed into service in month 10, we're sort of making the assumption that we may have bought it in January. But we could obviously adjust it to where that it was only placed into service, or only the mortgage was calculated and everything else calculated as if it was 2.5 months. Okay? That's a good observation. All right, moving forward. All right, so the before tax cash flow, what we do here is we take our before tax cash flow, we subtract out our taxes payable, which we have calculated from right above that, and then solve for after-tax cash flow. Okay, so that simply gives us our after-tax cash flow for the year. Now, subsequent to that, one of the things that we're going to do here is we're going to do a few return calculations, all right? And one that you can call return on asset, or just simply the net operating income divided by value, also cap rate would be another way to sort of look at that. So here, you're simply going to take whatever the net operating income is for that year and divide it by the value that we came up with. Okay, so we've got the net operating income of the $2,046,300, divide that by the overall value of the property of $31 million, and we should match up with the 6.5% as a return on asset. Now, one of the things that we sort of see as we go across, and this is an assumption that I made, is that the value we're keeping constant as we're sort of moving across the page, but the net operating income, as it changes or goes up in this case, then the overall return on asset changes. Now, once again, this is a super simple spreadsheet. A lot of the complexities haven't really been built into it in terms of making an adjustment for the value changing from one year to the next. We could have made that one of the assumptions and changed the value, and then ultimately that would have impacted what that return on asset would be. Now, the before tax return on equity calculation, that is simply the before tax cash flow So before tax return on equity is our before tax cash flow divided by our equity investment, all right? So in this particular case, for that first year, our before tax cash flow was $472,223.08, all right? And our equity investment, we go back up, was $7,866,463.50. Okay, so let's do that, just double check, see if it's correct. get 0.060029, it's basically around 6%. Okay? Yep.
Is that kind of the same as the cash on cash return?
Yep. It's another name for it,
Okay.
but same thing. So yeah, cash on cash before tax return on equity. Okay? And then the after tax return on equity, same formula except you're using the after tax cash flow. Okay, so your after tax return on equity is after tax cash flow divided by the equity. So in this case, the after tax cash flow, 231, 268.16. Once again, if we do the math on that, we should match up with a 2.94%. Double check. And we do. 0.02939, or basically 2.939%. Okay? So it makes sense. Now, here's an interesting question for you. So would you expect, as a general rule, probably in most all cases, with a few exceptions, your after-tax return on equity to always be lower than your before-tax return on equity? Yes or no?
Yeah.
Why? Because you're taking taxes out. Okay? About the only way that it could ever not be lower is if you were getting tax credits. Okay? Like, for example, historic tax credits, low-income housing tax credits, or other related tax credits that would potentially allow your after-tax cash flow to somehow be higher than your before-tax cash flow. But very seldom is that going to be the case. Okay?
So that's higher than tax evasion or something like that?
No, it's not so much tax evasion. It's just simply that there's got to be something that's, like, for example, what we would probably see is, here with our quote-unquote taxes payable, we would see another line item that we would insert in there that would be tax credits. Okay? Because there's a difference between a tax credit and a tax deduction. People always get them confused. They think they're the same thing, but they're very different. If I were to say, okay, I'm going to give you a $1,000 tax deduction versus a $1,000 tax credit, which would you prefer? Credit. Absolutely, hands down, without any question whatsoever, you're going to prefer a tax credit. The reason for that is a tax credit is a dollar-for-dollar reduction in your income taxes payable. So in other words, if I give you a tax credit of $1,000, then I'm just simply taking this tax payable number and I'm subtracting out $1,000. Do I follow that? Whereas if I give you a deduction of $1,000, it's going to be like this interest expense. It's going to be multiplied, after you get the taxable income, it's going to be multiplied by the tax rate, and so you're only going to get basically the benefit affiliated with the tax paid, okay? So you're only going to get basically about 28 cents on the dollar in terms of the benefit. Does that make sense?
Is there any instance where the credit wouldn't be the better choice?
Unless you just don't qualify for the credit.
So why would there even be an option? Why would it be?
Well, I'm trying to just to illustrate the concept.
Oh, sorry.
But as a general rule, I mean, like I said, the big ones for real estate, for tax credits, historic tax credits, health preservation tax credits, if you basically take an older building or historic building, there are different income tax credits that basically, for every dollar you spend on the rehab, then you will, in essence, get back a fixed percentage tax credit.
Okay.
Dollar for dollar reduction in income taxes payable. Whereas with tax, and then the other big ones are going to be low-income housing tax credits. Same thing. If you provide and build low-income housing you will get a dollar for dollar reduction in your income tax payable for those properties being built, up to a certain percentage.
Okay.
Okay?
Don't we have to adjust the property value over the years to get a higher ROE in ROA? Because every year the property value goes up based on the NOI, right?
So one of the things, that's what I was saying earlier, that this model doesn't do that. This model is meant to be a very simple model and not necessarily make a lot of the other little assumptions that we potentially could make. And so you're absolutely right, that as you gain equity in the property, you could be effectively arguing that you've got more equity in the property because of equity buildup, and therefore your return calculation should be based upon your current level of equity in the property and not based upon the initial amount that you put into the property. So that is an assumption that you can make, absolutely. Okay? All right, so once again, we're keeping those somewhat static. You can kind of see what happens, obviously, as the property sort of matures. For the most part, those return measures go up. Okay, moving forward. Okay, so now what we begin to do is basically say, all right, let's look at the actual cash flows being thrown off by this property and put those into basically kind of a return measure, like internal rate of return, net present value. So what I have done is broken up into the three major sort of return measures, which are going to be looking at assuming that it was an all equity deal, all cash, which it's not, but assume that it were, what would be the cash flow streams associated with that? What would the cash flow streams be if we are obviously putting equity into it, we do have debt, what is going to be our cash flow streams on a before tax basis, and then what are going to be our cash flow streams as if it's on an after tax basis. Now, why do we want to separate these things out? Well, once again, most of us, whenever we think about returns, and pretty much almost any investor that you talk to, they're almost always going to refer to their before tax returns. They're not going to be really referring so much as I want to get an after tax return of X percent, because most investments are just, whenever you're talking about, you don't know what an individual's tax liability would be, because each person is going to be different depending on how much overall income they have, or whether or not they're an individual versus a corporation versus a partnership versus a syndication versus a joint venture versus something else, okay? Because those different ownership structures are going to influence whether or not, you know, they have to pay taxes or they don't, and what rate, you know, and that sort of thing. So most of the time, whenever you're quoting anyone a return measure, it's on a before tax basis, okay? That's simply said. But that having been said, if we know the details of this particular investor and what they're being taxed at in terms of what rate, it makes sense for us to go ahead and do the after-tax calculation so that we can see what is their real take-home after applying the tax rates, okay? All right, so let's make sure that you know where these numbers are coming from. The $31,465,853.98 is simply what? The overall value of the property, okay? And then the cash inflows. See what those numbers are. Where are we pulling that from? Net operating income. So years 1 through 5 of net operating income is all these numbers represent. Now, the cash flow at end of year 5 plus reversion, that is simply going to be the final year cash flow of NOI plus whatever the reversion value is. Because if it's an all equity deal, there is no debt, so therefore you don't subtract that out. So all you're going to be doing is basically taking this number, the reversion value, which you're getting by taking and applying the cap rate of 6.5% to the year 6 NOI. Okay, so if we, just to kind of prove the point, year 6 NOI, pull off of here, NOI for year 6 is equal to $2,360,000. 63, 653, 73, all right? And if we divide that by the 6.5% cap rate, then we're going to get the value of the 36,363,903.54, which should match up basically with this, or pretty darn close, okay? Off by a couple of pennies because we're rounding, okay? All right, make sense? So, this is just simply going to be taking those cash flows with our reversion value, and then once we've got that, then just doing the basic return calculations of internal rate of return and net present value. So starting with internal rate of return, you should be able to match up with that 9.44 by plugging in all of this into your calculator, same way that you do any of the calculations. Your initial cash outflow is going to be the $31,465,853 as a negative cash outflow, and then all of the subsequent years as positive cash flows. Solve for internal rate of return, and you should get the 9.44. Okay, make sense? Okay, and you would, in essence, you would apply the same approach for the others. We're going to talk about the differences there here in a second, but let's finish up with the all cash deal here for a second. Now, take a look at this investor hurdle rate for the net present value. We've talked about this a little bit, but I want to make sure this is super clear in your mind. What is a hurdle rate? Real simple. It's a target rate, or it's the rate of return that I, as an investor, am setting for myself or for my organization that I must meet and I must get over in order for me to do whatever investment. So in other words, if I've set the hurdle rate at 20%, okay, for an all equity deal, have I met that hurdle rate? No. So in other words, I could not do this deal if it was an all equity deal, because the rate of return that I'm actually getting is 9.44, but if I did it as an all equity deal, 9.44 is not sufficient for my equity. My equity demands maybe a 20% rate of return, all right? So in this case, I'm saying, well, my hurdle rate is not met, therefore we get a negative net present value. It doesn't make sense for me to do this investment, okay? Now, we're going to get into the other ones here in just a second, but I want to start up at the top with the before tax cash flows. Okay, does everybody understand the first column? Yes? Okay. So the second column with the before tax cash flow, what we're doing, look at the dollar amount of the outflow. The dollar amount of the outflow in this case represents what? The equity. Okay? That's the amount we're putting into the deal. Well, is the equity the same for whether it's a before tax return or an after tax return? Yes. You're expending the same amount of money in both instances up front whenever you buy the property, okay, in terms of the equity contribution. But what is different are the cash flows subsequent to that. So here, the cash flows for the before tax return, that's simply going to be using what? Your before tax cash flow for each of those 5 years. And in the 5th year, we have to add in the reversion value. Well, here, this is where it begins to be a bit trickier, okay? And in the investments class, we'll get into even a little bit more detail on this. But if you go down toward the very bottom here, under these assumptions, the whole extra set of calculations that we've got to do as it relates to the sale of the property. So we've got to go through, figure out what the original adjusted basis of the property is, that $31,465,000. What is that? That was the improvements value of the property. Okay? Then we got to subtract out all the depreciation that we've had over the 5 years of ownership to give us our adjusted basis of the sale. Then, from that, we've got to do another little subroutine, take the sale price of what we sold it for, subtract out that adjusted basis that we just calculated. Then that's our gain of 7.6 million. Then from that, we have to subtract back out the cost recovery depreciation to figure out the overall gain from appreciation in the property. Now this is really where it starts to get interesting and wacky, because you get taxed on two different things here. You get taxed on the value of the property going up, which is the tax on appreciation, but you also get taxed on the depreciation that you have taken, or the recaptured depreciation. In other words, here's the logic. The IRS has said, oh, you bought this property, it should have gone down in value, not up in value. Therefore, we've given you all these tax benefits for all this depreciation for the past 5 years, but what's actually happened is the property has gone up in value, so we want you to pay us back the tax benefits that we have given you for the depreciation over those 5 years. That's what's called cost recovery recapture. In other words, the IRS is basically taking what they gave you and taking it back, okay, and taxing you on it. Okay, does that make sense?
So do you ever win?
No.
And they're hitting you for your appreciation as well.
This is why currently we have two different tax rates as it relates to the sale of the asset. We have a tax on the cost recovery, which is basically the recaptured depreciation, which has a 25% tax rate, and then we have a tax rate on the capital gain, which is at 20%. But then we have a different tax rate on ordinary income, which is 28%. Okay, so you've literally got three different tax rates as it relates to different types of income that the property is generating over its life. Okay, so yeah, it begins to make your head spin, you know, and then as, once again, tax law gets changed, all of that then blows up, and you've got to basically figure out what the new tax law is doing and how that's going to impact you, and then how do you maneuver your own ownership structure to basically reflect that to your best advantage. But the point with this, and like I said, we're not going to get into the nitty-gritty detail in this class as much as we will in the investments class, but the point is you're going to take what you sold it for, subtract out the balance of the loan. That's going to be what are referred to as your sales proceeds before tax. So this is the number, this 15,629, that's the number that we use as the reversion value for the before tax cash flows, okay? So you can take a look and see that those numbers match up. Yep.
Is the capital loss allowance included in the tax on capital gain?
I'm sorry, one more time?
The capital cost allowance, is that something included in tax on capital gain or tax on cost recovery?
Are you talking about for?
Yeah, that's something I read on the Wall Street Journal, that properties are paying too much in capital cost allowance.
Are we talking about for capital expenditures?
Yeah.
Okay, so one of the things, typically whenever you make an expenditure on a real estate property, it's going to be classified as either a capital expenditure or repair and maintenance, okay? You know what the difference is, Fina? The difference between a capital gain or specifically a capital expenditure versus a repair and maintenance.
One is recurrent and the other one is like once in
Capital gain for
3 years, right?
So basically, as an owner of real estate, in many cases, you have to determine from 1 year to the next whether you're going to classify an expenditure as either a capital expenditure or as a repair and maintenance. If you classify it as repair and maintenance, you get to deduct it immediately within that tax year. So in other words, if I go out and I buy a bunch of new carpet to install in a building, all right, and say that carpet cost me $100,000, I'm going to write a check today for $100,000, put the carpet in, but now the question is whether that carpet is going to be considered to be a repair and maintenance expense versus a capital expenditure. If it's considered to be a repair and maintenance expense, I get to deduct the full $100,000 of that expenditure in that tax year. But if it gets classified as a capital expenditure, then that allocation of that expense has to be spread out over the useful life of that carpet. So if we say that carpet has a useful life of 5 years in a commercial setting, then what we're saying is I can only, for tax purposes, then deduct 20% of that cost each year, basically, for 5 years. And so this is you have people at large real estate holding companies whose almost sole job it is to do nothing but classify whether something is going to be a repair and maintenance expense or a capital expenditure, because it matters so much in terms of whether they're going to be, how they're going to be taxed. Because would you rather get the tax benefit off of your ordinary income versus the tax benefit off of the recaptured depreciation? Well, there's a difference in tax rates. You got a 28% tax rate versus basically a 25% tax rate. Okay, well, that may not be that significantly different on millions of dollars. It is. Okay, all right, so we go through. This is once again going to be our reversion value for the before tax cash flows, and then after we subtract out the two different taxes that we have on the sale, one being the recaptured depreciation, the other being the gain on the sale, the capital gain, in other words, the amount above and beyond what we paid for it, then this gives us our sales proceeds after tax, which is what the value that we're going to use for the reversion for the after-tax cash flows. So if you look at that, those two numbers there obviously reflect the numbers from down below of simply what the reversion amounts are. Okay? Does that make sense? Okay, so those get added in, obviously, to the final year cash flow. So the 16,352 is going to be equal to the 15,629.73.80 plus what? The final year before tax cash flow of year 5. Okay, just like what we've done in other real estate finance calculations. Okay, and then the final one on the after-tax cash flows, same thing. This is simply reflecting, obviously, the 13,971 plus the final year of the after-tax cash flow. All right, now, let's jump down here again. Let's take a look at our internal rates of return for each of these. So the return that we said that probably matters the most to us is really this one, the 20.43%, the before tax internal rate of return, because that is the return measure that most of us are going to relate to in terms of what is our return on a before tax basis. So that is, in essence, our return on equity on a before tax basis. Now, in this case, let's say we set a hurdle rate of 15%, all right? With kind of the logic there being that the bank is basically financing the lion's share of this. We're only having to contribute a small amount of equity, therefore we don't have as much exposure. Therefore, we're willing to accept a lower hurdle rate, okay? It's kind of the logic that we're sort of using. But based upon that, under these circumstances, would we do this project?
Yeah.
Yes. Because if the project is returning 20.43 and our before tax, as our before tax internal rate of return, and our hurdle rate is only 15, then that means we're getting, in essence, a profit above and beyond our hurdle rate of over 1.8 million. Okay? Does that make sense? Okay? Now, on an after-tax basis, we're sort of maybe setting the hurdle rate a little bit lower, only to kind of reflect that we know there's going to be a difference between the before tax internal rate of return and the after tax, simply because of the income tax. So we're not going to set as high of a hurdle rate. So in this case, I just set it at 10%. And once again, our after tax internal rate of return is 16.3. Our hurdle rate for the after tax is only 10. So yes, it makes sense. On an after tax basis, we're actually going to be walking away with 2.3 million in essence as profit. So without question, this investment makes sense. If it is an investment that we make with debt. If we made it as an all equity deal, it doesn't make any sense at all. Yep.
I guess I'm just struggling to understand the logic as to how your value is increased after you pay taxes in this scenario.
In this scenario, the reason would be because the hurdle rate is lower.
Okay.
And it's not enough, okay, put it this way. If I were to raise the hurdle rate to where it's equal to the before tax hurdle rate, see what happens?
Yeah.
Okay? So by setting it somewhat lower, oops, you know, it's going to have a significant impact.
And you just can't, you just put those numbers.
Well, it's dependent. In other words, most of us go into any sort of investment, or at least I do, and say to myself, all right, I'm not going to do any investment unless I can get, let's say, 20%. All right? And if I can't get 20%, I'm not going to do it. That's my hurdle rate. Okay? So you may say, I'm not going to do any investment unless I get a 25% rate of return. That's your personal hurdle rate. It's unique to you or unique to your investment firm. Okay? In most cases, most institutional investors will have a very precisely picked hurdle rate that they want to achieve. You know, and it's just like any investment that doesn't meet that is immediately thrown out. Any investment that meets that hurdle rate, then they're going to take a serious look at and more than likely invest if there's no other issues to basically make them not invest in it. But it's the only reason it's there is it's a threshold that the expectation is you need to meet that threshold at a minimum in order to move
You're
forward.
to be interested in the project.
To be interested in the project. Okay? Other questions? Okay. Now, so let's do this. So what if I were to like say, okay, on an after-tax basis, I want to net $500,000, okay, on an after-tax basis with my hurdle rate. Okay, what would I have to do?
Set the present value.
No. Okay, let me make sure I'm being very clear. I want this number here to be $500,000. How do I get it to be $500,000?
Make the hurdle rate higher.
Your hurdle rate.
Make the hurdle rate higher.
Yeah.
Okay, so if I go over to the hurdle rate and I type in, let's say 15%, makes me to 425. All right, well, what if I go to 14%? Nope, too low. What if I go to 14.5? Oops, oh, 14.5. What if I go to 14.3? Oops, too low, other way. 14.6. 14.7, getting very close. Okay, within $7,000 at 14.8. So the point being is, if I am basically saying I want to get cash, if you will, above and beyond my hurdle rate of whatever it is, what would my hurdle rate need to be? Okay? Does that make sense?
Can you repeat that?
Okay. That if I simply want to get profit, if you will, of $500,000 or as close to it as I can get, okay, what would my hurdle rate need to be set at? In other words, that would be kind of a benchmark. In other words, because my goal might not be to get a certain percentage. My goal might be to get a pile of money, you know, and I want a $500,000 pile of money, okay? But what does that mean? That my hurdle rate would need to be set at in order to achieve that, okay? Does that make sense? Because your net present value is what amount you have left over above and beyond your hurdle rate. Yep.
So that's not necessarily the profit after 5 years, that's the profit plus what you.
Well, it's all a way of how you twist it and contort it, okay? Because what we're saying here, what I was saying was, I want on an after-tax basis $500,000 sitting on a table, you know, for me, in essence, on, you know, on kind of a after-tax basis, but prior to actually making this investment, what would be my hurdle rate? What would it need to be in order to allow me to achieve that? Okay? Now that may have no relationship inherently to what the actual rate of return is. It's just a different way of sort of coming at the problem.
But if you,
I mean, I would still, see, now, in this particular case, the other interesting piece of this is that this hurdle rate is less than the actual overall after-tax rate of return, okay? And so what we're basically saying is I'm willing to actually accept lower than what it actually is throwing off, as long as I get my $493,000 above and beyond that.
if you put the rate of return in the hurdle rate, it's gonna be the money that, the profit that
Right.
is trying to.
Yeah, so I mean, like, for example, if I were to type in, without even doing it, if I were to type in 16.3 right there, what is my net present value going to be? Zero. Let's just say, or $349, but only because of rounding, okay? Because then they equal, and therefore you end up with basically a zero net present value. Okay? Because where your internal rate of return is equal to basically your hurdle rate, your net present value is equal to zero. Okay? All right? Other questions? Yep.
You hear NPV, you hear internal rate of return throughout commercial real estate investment. Some people prefer one or the other. It's just out there. I think you understand what I'm saying. Why prefer one over the other? Is one
It's a way of
right?
looking. It's a way of looking at things. Do you look at things in terms of raw dollars, or do you look at things in terms of a rate of return on a dollar? You know, to me, the raw dollars, that reflects a pile of money. In other words, like for example, if I invest $100 and I get a 10% rate of return on $100, that's $10.
Right.
But it's also a 10% rate of return. But if I invested $1 million and I have a 10% rate of return, that basically is $100,000. Okay, so would I prefer $100,000, you know, versus $10? Yeah, but they're both the same rate of return. Okay, and that's the thing. It's just a question of, usually you're going to use both because you're wanting to not only reflect, you know, what is the rate of return, but also what is the magnitude in terms of the dollars that are being generated. Question?
No, I was just thinking, in my mind, if I'm comparing investments, it's always better to have the rates, I think. Wouldn't that make more sense if you're comparing rates rather than dollar amounts? Well,
Once again, it depends on what your objective is. That's why I specifically targeted the pile of money of the $500,000. You know, it may be that my objective is just to accumulate a certain set dollar amount, and that's what I'm going to be happy with, versus what the actual percentage rate of return is. Because sometimes people, you know, people think about returns in different ways. Some people think about returns as just simply a payback period. That how many years is it going to take for me to recoup what I have invested? You know, that's a very simple sort of measure. That if I spend $100,000 on an investment and it generates $20,000 a year, that means it's going to have a 5-year payback period. Okay? Assuming then no residual value, well then I got paid back exactly what I put in. But if it generates $25,000 a year for 5 years, then I'm actually going to get back an extra 25 grand as a result.
And that would be the NPV?
Yes.
Okay.
Okay? All right. Let's see. Anything else? Okay, so other questions that you've got about this spreadsheet or about how it works, or about any of the calculations before we do the little quiz? Okay.
Do you learn a little bit more about the investor hurdles in the investment class?
I would say so, yeah.
Set it,
Okay, you wanna take a quick break? 5-minute break. Yeah, please. Yeah, definitely, we can, figure that out. You got the form, you all signed.
Us for that. Let's hold off until you get them. Cool.
Because the advising office has the one on the first floor, they've got to sign off on it. International Affairs Office is a separate department, Career Development's a separate office, and the program manager is going to be Carl Whitrow. So yeah, I don't think she's signed this. No, I'm the program director. Yeah, she handles all the paperwork. Yeah, Carla, I'll write her name down. Carla Whitrow. They'll tell you who she is. Her office is on the third floor.
No, because it says you.
Yeah, no. I mean, I ultimately have to be okay with whatever internship you select. That's the part for the actual course credit. But this part is a separate process, which is to initiate the program training.
She's in the
She's on the third floor. Whenever you get off the elevator, you're gonna go through the wooden doors. Yeah, to the right. Should be the same. I don't know. I don't have it like right here. I don't have like a solution. I'm more than happy to take a look at it.
Should I just come to your office?
Yeah, sure.
Okay. Thank you.
residential property is 25.27%.
That's for you to, you had written that down.
Huh?
That was part of the test. Right? Oh, yeah, it's a tax. So, for which class? So, right, let's go. So, next week. So, next week, we'll do chapter 12, this, that's it. Where's back to schedule?
Okay, so this is,
Yeah.
this is,
Right.
probably doesn't begin, okay, no problem.
That's what I need to do, so, gotta figure it out. It's all in sequence.
There's one of those.
Okay, we got everybody's? Is that it? Okay, is that it? My last call. Yeah, that's it? Okay. Okay, while we're waiting, what we're gonna do, Louis made some great suggestions to improve our spreadsheet. So what we're gonna do, you're gonna either break up into teams or work on it individually, and you're gonna make the following modifications. You're gonna have the, adjust the year one cash flows to reflect the date placed into service. Number two, you're gonna add in another feature to allow you to change the growth rates for the occupancy rates, basically year by year. And then the third one is you're gonna adjust the return on equity sort of calculations to reflect equity buildup over time. Are those only three you made?
Yeah.
Okay, so let's work on those three. You can break into groups and work on that. And then after that, then we're gonna talk about your little projects from last week. Okay?
Two groups or the same groups?
Well, this, you just do probably just one other person. I wouldn't expect you wanna do a big group.
Come on, Brad.
Once again, this party should only be a two-person group. I can't imagine you need.
Oh, this is from last.
Yeah, this is totally separate. This is basically for somebody, a study buddy to help you see if you can jointly figure out how to make those modifications. November, December. So you do, 12 minus.
You have to use the numbers we have from the desk, or?
No, this is just, I mean, because ultimately, it should be it's all about the process, not about the numbers.
Yeah, let's go over the cash flow. Yeah, so let's go on cash flow.
Especially if I just point out everything else is
Yeah, that's right. One row, all three of them came after.
We're setting this question.
It doesn't matter. You've gotta make it where it's gonna automatically adjust it. So whatever month you type in, it will automatically adjust the first year's cash flow.
that is the
Cash flow at the end.
Does it matter before tax, after tax, both?
Well, it should all flow through.
I was gonna calculate everything out as a year.
Well, if we do before this, it's after, make it weird.
Okay, so here's what we're gonna do this. We're gonna make this a little bit of a game. The first group that can figure out how to do the first one, they're gonna get an extra 10 points. Second group, another 10 points, and the third group, another 10 points.
Lewis is disqualified, right?
Nope. Everybody on equal footing.
We're assuming November, this month?
It doesn't matter what the month is. You figure out what the month is. There's more than one way to approach it, but what I'm curious to see is how each of you choose to approach it.
The first one, are you saying before tax cash flow?
It should flow through the whole way, all the way through after tax.
It's already in the after tax cash flow, isn't it?
No, it's not.
Okay, so official cash flow is 16
That's fine, but as long as it's figure out how we're, exactly what we're trying to calculate.
We're trying to calculate positive cash flow with the day.
I guess that makes sense, but, but how does that affect it? Like, are we just trying to take the depreciation from this, because that's what we want? You know what I'm trying to say? Because in the actual part wasn't like my concern. It's what I'm supposed to work out to get in the formula.
First one is.
You asked the question, maybe it's not there.
Well, I just get the second one, so I get 10 points. Okay.
I divided it first year proceeds by 11 or what, lease sale? So every time we change this. Yeah.
You scroll down.
Did you write it by 11 or did you write, in other words, you gotta make sure that,
That's depreciation.
that if it's
Yeah,
11 months, that you only get,
Based on the 11 months.
especially with the 11th month, you're only gonna get 2 months worth of income.
So even if it's exceptional, it would be less than.
You're gonna get November, December.
Okay.
Yeah,
Okay.
They don't think that.
Does that have to go all the way through the IRR accounts or just down to?
Yep, everything, all the way down.
Okay, it's consideration. Because your cash outflow is zero won't change. So that's what we're paying for properties.
Correct.
It affects all the numbers, so I gotta change.
No. Okay, for the second one, to show you what I did, very simple. For the vacancy rate, I just stretched out basically that 7% and I just carried it out all the way across with the yellow cells, and then I just put in some random rates for the subsequent years. And then down below, all you've got to change is basically the first cell that was originally times $B, $5, and just make it B5 and carry it over. So that takes care of number 2.
They're actually still trying to figure that out.
Yep. Well, but the unfortunate thing is apparently carrying on like fix that.
The first one is done too, can we still hand in the first one?
No, it's not done yet. We're not ready. Only the second one, I haven't got it done and showed you real quick. So the first one's the hardest. The other two are pretty easy. Yeah. Well, except that needs to be adjusted. Yep. That's for a whole year. I'm saying though, the first one is the hardest one.
There's a lot to it, yeah.
You've also got to adjust, obviously, the other income, because it's pretty. So that's why. You gotta figure out how you do it.
Year one divided by 12, and then this also 12 minus multiplied service.
Okay. That makes sense.
Vacancies, stays.
Yep, relative, okay. So the other income, you've got that adjusted as well.
Your NOI, which is then that's for your tax rate. Like your tax rate multiplies that, which means your
Multiply that.
Right.
So
it's multiplied.
Add, subtract, and then NOI is,
This is your NOI, and then you have your interest expenses, taxable income, your tax.
aggregate service, we have to adjust it also to the amount, and then our cash flow is basically divided by, the NOI divided by ADS.
You're almost there. Because with the annual debt service, it's not gonna be just a simple divide by 12 and multiply by 11, because you've gotta consider that each period is going to be different depending on the amount of amortization that takes place.
see, yeah.
Yeah.
So, this thing will be 2 months.
So I just get rid of separate.
Oh, I got you. That's good, I like that. Well, as I was explaining, the one thing we need to take a close look at is the benefits, because as I said, it's not going to be just a simple percentage of the year, because with that one, you're going to have different amortization depending on the number of months. In other words, that half a year of amortization is not going to be the same as the actual 6 months worth of depreciation, or the 6 months worth of the breakout between principal and interest is what I'm saying. The payment itself will be appropriate for the annual debt service, but when you get to the interest expense, it won't be. So in other words, you're going to have to adjust that first year's interest expense from the beginning.
So do month one thing,
Right.
then be whatever month they're
Right.
in operation instead
Through.
of it calculating.
Right.
Okay. Right down.
I think so. First payments.
I just had to change them, so.
No. Yep.
We're like close to there.
Okay. You're very close. Okay, so I did on the third one to start with. Think about the logic. This is trying to get at what Lewis was talking about. And basically, you're including the equity buildup because, in other words, the equity that you initially contributed is going to increase over time as you pay off the loan. Yes? Okay, so as the equity builds up over time, we want to basically do a calculation based on the amount of that equity relative to what the income is, okay? So what I did here for this first year was to basically say, all right, we know that B17 is reflective of our what?
Equity invested.
That's the equity, okay? That's the initial equity. But it doesn't include the amount of equity that we paid off during that first year. So to get the amount of equity that we paid off in the first year, we would simply take our annual debt service for the first year, the 1574, and subtract out our interest expense. That would be the principal that's been repaid during the first year. So you simply would add basically this to basically the payment minus the interest, okay, for the first year. But now what I want you to do, figure out the logic for the second year. It's not that simple. See if you can figure it out.
Yeah, I got the first one.
Are you not even going to try payment?
We are.
Okay.
Payment is the rate divided by 12, comma, 12 minus the amount placed in the service.
Yep.
Times 12,
Yep.
comma, C14, that's the PV,
Yep.
comma 0, and then all that divided by the amount placed in the service. I think that's the right logic.
I think that makes sense.
12 should be 0 because there's nothing.
Right.
It starts in January.
Yep. So I think you can make it up. Keep this one low, maybe. No, maybe not.
Close, right?
Yeah, not quite. Think about that one.
Porque mira, so we can do all year.
Are we assuming the operation, the date goes into operation is the sale date or is the purchase date?
Yes.
Okay.
I was a buyer right so that would make sense. Set up a bit.
But, no, you could have included the following. Yeah, you gotta make sure that you get each year summation. Right, correct. Good.
Almost there.
Regular,
Okay, I think I've got now for the before tax return on equity for all years. Looks like with the adjusted formulas for basically taking into account the equity buildup. So it looks like over time, obviously your return is going to be getting higher and higher. Okay.
Yes.
Okay, so those are some work ideas. Okay, you pretty much got it, Louis? No? So
No, close, but not.
okay. So, what, I think Louis is still struggling, are you still struggling with the payment part?
Yeah.
Okay, because you're basically trying to get what is the debt service. Well, the annual debt service, that one is easy because you can break that one up by month, but the one that's gonna be more complicated is the interest expense.
I got that pretty well.
Yeah, because there, it should be, your start period is going to be 1, but depending on what the month placed in the service is, that's going to dictate how, like for example, if it's placed in the service in October, that means you're going to be making payments of October, November, and December, which would be 3 months. So you're going to only get the interest portion for months 1 through 3, but that also is going to impact your second year's interest. So you're going to have to somehow figure out a formula that's going to adjust that to begin with month 4 to then run forward for 12 months after that. Does that make sense?
Yeah.
So the 1 to 3 is not being used at all in the calculation.
not for the annual debt service. The annual debt service one is pretty straightforward because that one you can break it out because it's going to be consistent from month to month, okay? Because your monthly payment doesn't change. What does change is the dollar amount that's allocated to interest and to principal, okay? And so what I'm saying is that if the property is placed into service in October, then that means that you've got payments for October, November, and December. And so technically for interest purposes, using the cumulative interest function, you're going to have to say this is going to be months 1, 2, and 3 for the first year, but then that's going to impact the second year. So January of the second year is now going to be month 4 through whatever the plus 12 is going to be. So what is it, like 16?
December.
Or is it going to be 15? Let's see.
12 plus 4, 16.
4, 5, 6, 7, 8, 15. Needs to be 15.
Yes.
So February, March, April, May, June, July, August, September, October, November, December. So yeah, so the second year is going to be months 4 to 15. And then the subsequent, so you're going to have to, what we're going to have to do is an cumulative interest function, we're going to have to set up to where it's going to know where to start relative to where the first year ends. Does that make sense? Because you have the start month and the end month. So let's see if we can figure that out real quick. So basically, if we come down here to the interest expense function, just that one alone, and we simply say, okay, the start period is going to always be 1 in the first year, so that part is okay. And then the part that we're going to have to substitute here for 12 is going to be some sort of a formula that probably would be what? Okay, so 12 or 13 minus the month it's placed into service, 10.
You got the minus
So E12. So basically 12, 13 minus E12. Well, it should be 13 minus E12, which, okay, 13 minus E12 would be, if it's a month 10, so if it's 13 minus 10, that would be 3. Yeah.
The first period is 4 for year 2. Right, year 2.
Oh, no, I'm just telling you one. Sorry. Okay, so in this case, I'm wondering, does that make sense for that first year? Okay. Is everybody following what I just did on that one, on the cumulative interest function? That all I changed was to make it 13 minus E12. Now what we're trying to figure out, the logic for the second year as to, wondering, what are you doing with it? Gotcha, okay. So you're basically, you're taking, all right. So for the start is going to be the 13 minus E12 plus, no, I think that's gonna do it. If you want it to be starting with month 4. Yeah, okay, no, well, minus 12. Which would be plus 1, what you're saying? Okay. But then what about the second part of it? Is that just going to be? Okay, so 13 minus E12 plus 12. Or 12 plus 12 or plus 13? No, you're supposed to be 4 through 15. So 13 minus 10 will be 3, 3 plus. Interesting. I like that. Okay. Yeah, that's what, yeah.
Guess we had to go all the numbers, I did.
No, but I mean, it's an excellent sort of exercise to go through and try to figure this out. Logic.
So 10 points?
Okay. Louis, you want to try to walk us through what you have done up to this point?
Well, I only solved the ADS to reflect the month placed in service.
Okay.
That's what I've been working.
Okay.
So far, I haven't done the other two modifications.
Okay, so let's just think through this. Looking at this first year, and this is, and I haven't thought about this other than what you sort of shown me, but as we sort of think about this first year in terms of what we're going to have to adjust, the first part should be fairly simple, obviously, in terms of coming up with an adjustment for the potential gross income, because there, we're just simply saying, okay, what month was it placed into service, and then based upon the month that it was placed into service, then, you know, we're, like if it's placed into October, we're going to get October, November, and December, so 3 months, 3 out of 12 worth of income. So it could be as simple as adjusting that times basically whatever month it was. So like if there's 3 out of 12, then just 3 times 12. But the problem with that is doing it just like that, as you can see the problem that everybody ran into, is then it's going to obviously affect all the subsequent years. So you've got to isolate it out to where obviously it's not going to affect those subsequent years, and that's part of what some of you I know have been, you know, sort of struggling with, is dealing with the isolation aspect. So that's one issue. Okay. Another was with the other income. This was a fixed number, obviously, that's over the course of the year, so you had to adjust it to where it is based upon obviously just the proportion number of months that it would be potentially utilized. Then when we kind of came down to the operating expenses, that should have been a fairly easy one, to, obviously from an adjustment perspective. Now, we were talking about the annual debt service. The actual annual debt service, that one should be okay, just to a month, to adjust based upon the number of months, because the payment is going to be the same from one month to the next, okay? So that one, once again, should be a fairly easy adjustment, because you're just going to be dividing by 12 and then multiplying by, you know, however many months it's in service. All right, then we sort of get down to the annual depreciation. That one, we've already made the adjustment for, okay, so we're okay with that. The interest expense, as we said, that was another adjustment that we had to make, and what I did on that one, as I pointed out earlier, was for that first year, is basically the beginning period is still going to be 1, but the ending period for the first year, I did 13 minus E12, which was the month placed into service. Okay? And as we move down, all of that should be okay. And then this other piece that I was working on that I've already sort of shown you was to figure out before tax return on equity, and all I'm doing here is, in essence, increasing the equity as we sort of go across relative to the amount that has been paid off up to that point. And so I just simply took the annual debt service, subtracted out the interest expense, then that became the dollar amount of added equity to the deal, okay? And then kind of modify that as we sort of go across. But my point in doing this is, I think, this is the valuable sort of mental acuity that you need to be able to kind of think through these things. Because if you're building spreadsheets on your own, you've got to be thinking through this sort of logic. That's what you've got to be doing. You know, I've made it incredibly easy on you in the sense of, okay, here's a spreadsheet, pretty much already done. You know, you've got to change a few little things and sort of see what you can do. But what you really are going to need to be able to do is obviously be given, okay, here's a problem, now build a spreadsheet that solves everything, okay? And so part of what I'm trying to force you to do is to begin to kind of think through some of these logic things. There's not an absolute answer for some of these things. Sometimes you can come at it from 2 or 3 different angles to actually get to a resolution, okay? But part of it is you've got to, you know, take the effort to try to think through and the logic to sort of get there. All right? Okay. All right. Any questions?
I want to show you my formula for the annual debt service.
Okay.
Because it took like 20 minutes to do it, and I think we deserve some credit for that.
Do you have a HDMI port?
Yes.
Okay.
HDMI.
Maybe blow it up a little bit.
Okay. Can you see it?
Nope. Blow it up a bit. Like that. Zoom.
Okay.
Go to view. And then there we go.
Okay, so for the first year, I included a different column between A and B, this one. So the numbers here didn't impact the following years.
Yep. I think you do the same thing, didn't you, Dustin?
Yep. So this number here is the formula we came up with.
Can you blow that up a little bit more, like zoom in?
Yeah, please.
Even more.
1 second. Better?
Keep going. That's probably, okay, that's readable.
Okay. So basically, for the first year, in PGI, I took the gross potential income of first year divided by 12 times 13 minus the month placed in service. 13 because you gotta take the current month you are placing or acquiring the property. That's why it's
Yep.
13 and not 12.
Yep.
Then the next one is vacancies. That's basically PGI times the vacancy that you
Right. Vacancy
have.
rate. Yep.
Other income is very similar to a PGI formula.
But the only thing, make sure that you make that vacancy number a negative number.
Negative number, this one.
Yeah, because it's obviously right there.
Oh yeah, here in effective gross income,
Oh, you just did the math to make it
I did
negative?
a math to
Gotcha.
reflect it. That's the easy part here on the total operating expenses.
Yep, same
Also very
thing.
similar to the PGI and
Yep.
the TOE formula. And then for the annual debt service was a little more tricky. For this one I took the maximum ADS, I divided that by 12, and then times 13 minus
the month placed in service.
Yeah.
But to actually reflect all that, I put the parentheses and I divided that again by the month placed in service.
Yep.
That way, when I change the month placed in service,
Yep.
it reflects in here. Let me show you.
Yep.
See January?
Nope, not quite.
Not quite?
Well, this January shouldn't be the same.
Yeah, it should be the same.
It's the same, right? Yeah, wait. Maybe something.
Maybe your parentheses.
Forgot this?
12 instead of 15.
Huh?
12.
12. Times 12.
12 minus F12.
Yeah, maybe this number should be 12. Yeah, here it's actually, wait, 1 second. See?
Yep, there we go.
It was 12. I thought it was 13 that one. So yeah, I go, if I increase the amounts, see?
Yep.
It changes,
Yeah.
so now
Yep.
it's more
Yep.
reflected. Now it makes more sense.
Can we show your PGI formula again, if you could please?
Yeah.
Okay, thank you.
So this one was the hardest one, the ADS.
Right. Well, the hardest one is still, I think, the interest expense portion.
Yeah, that one I didn't spend time in.
Yeah. Okay. Good.
Well, yours.
Yeah.
It's here.
So, thoughts, questions about that? So any other things that you can think of that we could potentially try to make this even more realistic? No other adjustments that you can think of to make this spreadsheet more realistic?
Well,
I know you're worn out, but no, come
Well,
on.
a lot of, like, when you modeling stuff like this, you can project rent increases at a steady rate, but going in hard coding where, you know, once you spend $2 million modeling, building, or whatever, what you're gonna be able to jump rates to. And so you have your existing income at a lower rate, and then in year 2 or whatever, you're gonna jump a significant amount based on some capital improvements.
What are the
After class, after ROE, we have to change it. Okay. Because we changed the before taxes.
Yep.
ROE.
Yep, we can do the after tax, yep.
We can do the after that.
Yep. What I was gonna say, one of the things that you're gonna sort of, I think, have a better understanding of after just doing what we just did, whenever you take the Argus class, that's gonna be offered obviously starting in the winter session, that basically takes us to a whole new level in the sense of all the different variables that you can change to ultimately impact the cash flows and all the different assumptions that you can make about growth in income, changes in basically equity buildup, whatever it might be. And the beauty of Argus is that virtually any and all assumptions that you want to make, if you program it in there up front, it will do it for you without necessarily having to know what the formulas are to sort of get there. Okay, that's the beauty of Argus compared to using Excel. Okay. All right. At this point, what we want to do, have you guys talk a little bit about your project that you submitted, obviously, to me via email. And once we've done that, then we will be done for the day. Okay? So, Let me pull up, let's see. Okay. This is Lewis's. Okay, Lewis, you want to talk about this?
Okay, yeah, I can. So me and my group are doing the industrial investment. So here I pretty much, yeah, we type the investment highlights, all the different details, like year of build, parking ratio. The construction cost per square feet before, we got $60, but in this case, because it's a class B minus industrial office warehouse, it's actually $126 per square foot, a little higher than we expected. Because it's a high premium space, we think we should bring a top tier tenant to occupy the whole space. That way we can pretty much sell the property at a lower cap rate or refinance at lower loan terms. Those financing terms that you can see, I was in conversation with a broker from LoopNet, and he recommended me a mortgage broker. So I talked to him on the phone, and he gave me those numbers. Those are rough numbers, by the way. So by having these financing terms, we don't need to have a recourse on the loan, and we don't have a prepayment penalty fees. That way we can either sell the property in the first year or 3 years with no penalties. And if we lose the property, we don't have to, in the case we lose the property, we don't have to give any personal guarantees. So basically our plan here is to buy the property and bring in this top tier tenant and commit the tenant to 5 or 10 year with a 5 or 10 year lease, and then sell the property before the 3rd year. Why before the 3rd year? Because after the 3rd year we have a adjustable variable rate, and that's going to increase obviously the interest rate, and we're going to have to pay more payments on the loan.
Okay.
Those are some pictures of the property. It's in Doral, by the way. It's well maintained. And that's the conclusion, basically what I just said, and we have to have those conditions in order to have a feasible project.
Let's look at the spreadsheet here.
And then on a spreadsheet, we are taking into account that we're going to get a small discount on the property. So instead of paying $6.75 million, we're actually buying the property at $6.7 million. Then we go through the analysis, and we get a rent required per square foot of $20.67.
Okay, so talk to me about this. Talk to me about the operating expenses. How did you get those? What did you do here?
Well, that's basically 25%
Okay.
of the
Gross income. Okay.
yeah,
I see that.
the PGI.
Okay.
And I was conservative in that number because we are assuming that we are bringing a top 10 where we can charge a triple net lease or some sort of hybrid lease and get less expenses on our side.
Okay.
So 25% is actually very conservative for this scenario. I assume a 95%.
It's a single tenant, right?
It's a single tenant, yeah.
See, and this is where, everybody has a little bit of a different philosophy on this, but if you're going to have the tenant for the full year, and there's, you've already factored in, I guess, that if they're a high quality tenant, and you're not gonna have any sort of vacancy or collection loss, you might as well put it at 100%.
Okay.
Well, I know, I'm just, I'm not, it's not
Yeah,
a criticism, it's just,
understand.
but the reality is, if it's a single tenant building, and there's really no chance of them not paying the rent, then why would you not want to go ahead and include all of the income?
Yeah, you're right.
Okay, now, if it's a multi-tenant building, you know, where Vince and Cooper are gonna be moving in and out, then I don't know that I would do that, obviously. But when it's a single tenant building, it's hard to, for me to wrap my head around,
Yeah.
doesn't make any sense,
Okay.
all right? But if we did that, just put 100%.
Okay.
Obviously, that lowers down the rate that you would even charge,
Exactly.
okay?
This one is a back door procedure, basically the same as front
Right.
door. But it changed the.
Yeah, I mean, you know, the thing that you obviously illustrate, if nothing else, that the numbers we've been using in terms of the interest rates and the loan term and you know, debt coverage ratio, all of those are right in line with what effectively is happening in the market. So, no, that's good. Okay? And anything we need to say down here about?
So here I basically did a brief pro forma, assuming a 4% annual growth in potential gross income, 3% growth rate in the total operating expenses. As you can see, I'm assuming on the first year that we're gonna take 6 months to find a tenant.
Yep.
And have him, sign a lease of 5 to 10 years. That's why during the first 6 months, we don't have any income.
Right.
And we actually have a loss at the end. And that loss gets carried out over the years until we finally pay that debt on the third year.
Okay. You sell it.
And here on the initial cash outflow, I'm assuming the equity that we need to buy the property, and also I'm assuming $75,000 that are gonna be spent to renovate the finishes and the retouches of the property,
Okay.
like the entrance and the lobby.
Yep.
That way, when we have prospective tenants, they can appreciate more the property, I guess.
Okay. So did you do anything with deal structure, or is that just?
No, I haven't done that one yet.
Okay, okay, all right, good, thank you very much. All right. Let's see. Here. There's the project. Okay, Ken, we'll talk about this.
We didn't get into that much detail yet, so, that was just what we did last week. It's 20 townhomes in Cool Springs. I just kind of worked through, we took what we thought we could offer, based on a 6% going cap rate. That was kind of like our bare minimum cap rate. So we kind of worked backwards from the NOI
Okay.
to come up with a, offer price. The
Okay.
loan was pulled from the website right there,
Okay.
the loan terms.
Yep.
We have some more detailed ones that we've got in the meantime, but that was just in class the other day.
This one, commercial loan, right?
Right.
Okay.
But we spoke to a broker in the meantime, so I have some more
Okay.
detailed
Fair
terms.
enough, fair enough. Anything else on the other, on the back door side?
No, I mean, you can see on the backdoor side, the maximum supportable site acquisition cost, the actual, what's maximum supportable is more than what we were willing to offer.
Yep.
Just because you can see the going in there is 5.7 versus our minimum was 6.6%.
Gotcha.
So,
Okay.
other than that, we didn't get into much more detail.
Okay, all right, fair enough. Let's see. Who else had sent me one?
Mariel,
Eduardo, when did you send me yours?
Sunday, Monday.
Oh, so you're already in the week. There's Sunday. There it is. What's this, I'm sorry?
It's a picture and
That's the one. See with the Legacy Bank.
Yes.
the email has a picture and the address as well.
Okay, so not a lot of additional detail. Okay. All right, the only other one I guess I got.
Last Saturday, we sent it.
Okay, yeah, that's right. You're the early birds. Yep.
There it is.
Oops. Okay. And anything you want me to walk me through, or?
We just, ours was retail, I'm trying to remember what we did, so that's what it looked like, that's where it's in the map. We decided in the end it wasn't feasible, because what they were asking, price-wise, and what we were able to get per square foot in rent did not make sense at
So
all.
you're saying, okay, you were saying that basically you think you might be able to get $40 a square foot that they're at, but you would probably have to get 55 in order to make it.
Yeah.
Gotcha.
To pay what they wanted, so.
Yeah.
You even dropped down $1 million and it still didn't make sense, like price-wise. Play around.
Any sort of explanation for that, other than they're just overpricing it? You think there's anything that you're missing potentially?
It's new construction, I mean, that could be attributed to high price. And that kind of screwed, we were gonna break it into 3 separate stores, probably one bigger and then 2 smaller ones. And, we couldn't even do that, we couldn't afford any other construction costs on this year what they were asking.
It's vacant, right, so they could use it for a user to buy it.
But so,
Yeah, it's
you're saying, in terms of the spaces, you're saying that it's condominiumized, in the sense that each space is?
It's not, right now it's one restaurant.
Oh,
We
okay.
could have broken it up.
Oh, okay, I got you, all right.
That was our original game plan until we ran the numbers and found out that's not an option.
So who's this? Okay,
That's where we got our data.
Gotcha.
Financial data.
okay. So did anybody run across any interesting sources of information? Sources for financing or anything they want to share? Okay.
That website I had.
Call your local banker.
Pretty good.
Okay. All right. Okay, is that it? I think we get all the groups or not? We get one from you guys?
No.
Yeah.
I don't know, you bought it.
Who sent it to me?
I
Paul.
did.
Okay. When did you send it, Paul?
Thursday night. What's that? No, Thursday, Friday morning, 1 hour.
There it is. Which one should I pull up?
Well,
There's 4 files here.
yeah, there is, because, well, we had a mixed-use property, and it was tough to
Okay.
find one, so we
Okay.
found one in Miami.
But she basically did 4 files on the different uses?
2 uses.
Okay.
But however, what they were doing, it's 2-story. The bottom floor, it's about 2,100 square feet. Now that can be rented as office or retail. And then the top is set up as apartments. And they have 3 apartments up top. So there's an offering memorandum. And going through the pro forma and offering memorandum that they had sent, kind of had to analyze it and look at it and see what they were doing, because they did do kind of a small pro forma. And the ground,
You didn't send me that, did you?
it's in there. If not, I have it here.
No? All I'm seeing are 4 Excel files.
But it helps verify.
Thank you. Is it embedded within one of the Excel files?
Yes.
Oh, okay.
Yes.
Probably one of these larger ones. I'm gonna go with that. That would make sense.
Okay. Okay, property details out.
Okay, so this is, yeah, where you went through and, okay.
Well, Christina, you want to kind of tell them your thoughts of how you kind of separated it and what you thought, and then we ran a couple different scenarios based on what they had.
Okay, so the first floor, we've got 1 unit, second floor, 3 units, and those are, it's residential on the second floor,
Correct.
and then office on the first floor?
Correct.
Okay. And I mean, anything you want to add?
Well, anyway,
No, I thought you were running through it.
what's that?
I thought we were running through it.
Oh, okay, well, I thought it was a good thing, but anyway, the way they had the expenses set up was, they were only showing net, for your total operating expenses, they only had it in place for one floor, not for 2 floors, if that makes sense. And I think I came to the conclusion in analyzing the way they're doing that, it says ground floor triple net lease. You see that on the first.
Okay, so basically it's a pass through.
It's passed through, right.
Gotcha, okay, that makes sense.
And then, so we took a blended rate for up top for the 3 different apartments.
Okay.
Okay, and went with that and ran through. And then, same thing with the ground floor.
All right.
And then some of the other spreadsheets show some other scenarios.
All right. All right. So this next week, next Saturday, we will have another spreadsheet. I have yet to determine what it is, since we are going to be combined the before tax and after tax into today. So I'm going to come up with something new and interesting for next week, and then the following 2 weeks, then we've got, I think, the efficiency, or building efficiency, and then the creation of a underwriting model. Okay? Perfect. All right. We will see you then next week. Enjoy your holiday.
Go back seconds.
Yeah, Tuesday through Thursday. Okay. Yep.
And I'm late. I will see you guys next week. Happy Thanksgiving.
Oh, I'm sorry. Okay, one more time. Yeah, stop by, just let me know when you want to stop by. Be fine. Just send me an email. Okay. Okay. Yes.
Christmas.
Yeah.
I'm planning on it.
Okay.